Picture this. The economy is crashing. People are losing their homes. Businesses are shutting down, and panic fills the streets. And yet, when the dust settles, some of the world's biggest banks emerge even wealthier than before. How is this possible? How do banks profit from the very crises that devastate everyone else? Today, we are pulling back the curtain on one of finance's darkest paradoxes: why financial crises do destroy big banks. They make them richer. Let's dive in. When a financial crisis hits, chaos reigns. Stock markets plummet, credit freezes, and companies start to collapse. But for large, well-capitalized banks, a crisis isn't just a disaster, it's an opportunity. Here's how the playbook works. First, the fire sale. During a crisis, weaker banks and financial institutions fail. They're forced to sell off their assets, things like loans, properties, and securities at rock-bottom prices, sometimes for just pennies on the dollar. And who's standing by, ready to buy? The big banks, with their deep pockets and government backing. Think back to the 2008 financial crisis. J.P. Morgan Chase acquired the investment bank Bear Stearns for just $10 per share. Just months earlier, that same company was valued at over $170 per share. In a similar move, Bank of America bought Merrill Lynch at a tiny fraction of its former value. These weren't charitable rescues, they were strategic acquisitions. They eliminated competitors and expanded market dominance, all at bargain basement prices. Once the economy eventually recovers, those cheap assets become profitable gold mines. The big banks didn't just survive the crisis, they used it to consolidate their power. But there's an even darker secret at play: the government bailout system. When banks grow large enough, they become too big to fail. This means their collapse would be so catastrophic that it would drag the entire economy down with them. Governments know this, and more importantly, the banks know this. This creates what economists call an implicit subsidy, a hidden guarantee that taxpayers will be forced to rescue them if their risky bets go wrong. During the 2008 crisis, the U.S. government stepped in with over $700 billion through the Troubled Asset Relief Program, or TARP, to stabilize the financial system. Major banks received massive injections of capital. The insurance giant AIG alone got a staggering $182 billion. Now, here's the twist in the official story. Many of these banks eventually paid back the loans, and they even paid interest. The government later claimed that TARP actually made a profit of around $10 billion. Sounds like good news, right? A win-win for everyone. Well, not quite. What this simple narrative completely ignores is the invisible cost of that implicit subsidy. Even before the crisis, this hidden guarantee saved big banks about $4 billion per year in lower funding costs. But during the crisis, that subsidy skyrocketed to an estimated $60 billion annually, peaking at $84 billion in 2008 alone. These reduced borrowing costs gave large banks a massive unfair competitive advantage. It allowed them to take on much bigger risks, all while knowing that taxpayers would ultimately backstop their losses. It's like playing poker with someone else's money. Here's another mechanism they use: interest rate manipulation and control over lending. During a crisis, central banks, like the Federal Reserve, slash interest rates to try and stimulate the economy. This allows banks to borrow money at ultra-low rates, sometimes near zero. They then turn around and lend that same money out at much higher rates to desperate businesses and consumers who are struggling to stay afloat. This gap between the low rate they borrow at and the high rate they lend at is called the interest rate spread. It's how banks make their bread and butter. During a crisis, even if the total number of loans they make goes down, the profit margin on each individual loan can actually increase. Why? Because borrowers are more desperate and willing to pay premium rates for scarce credit. At the same time, banks tighten their lending standards during a downturn. This makes it much harder for ordinary people and small businesses to get a loan. This scarcity gives the big banks even more pricing power. They can charge higher interest rates and fees simply because there are fewer competitors willing or able to lend. So while everyday people face higher borrowing costs for mortgages, business loans, and credit cards, that wealth is effectively being transferred from struggling households directly to the balance sheets of the big banks. Financial crises also act as a powerful catalyst for consolidation. Smaller, regional banks often fail or get absorbed by the giants. The result is a market with fewer players, each controlling a larger piece of the pie. After 2008, the United States saw hundreds of smaller banks disappear. Meanwhile, the top banks, Morgan, Bank of America, Wells Fargo, Citigroup grew even larger, controlling trillions and trillions of dollars in assets. This concentration of power has serious, long-term consequences. With less competition, these megabanks can get away with charging higher fees for basic services, offering lower interest rates on your savings accounts, and wielding more influence over economic policy in Washington. They transform from simple financial institutions into powerful economic gatekeepers. And because they're now even bigger to fail than they were before, that implicit government guarantee grows even stronger, perpetuating the cycle of reckless risk-taking and inevitable bailouts. This brings us to a critical concept known as moral hazard. Moral hazard is what happens when you protect someone from the consequences of their actions, which in turn encourages them to behave more recklessly. If you know that the government will save you no matter what, why wouldn't you take massive risks? High risk, high reward bets can yield enormous profits if they succeed, and if they fail, the taxpayers absorb the losses. Heads, the bank wins. Tails, you lose. This isn't just a theory. It's exactly what happened leading up to 2008. Banks engaged in reckless lending practices, packaging toxic mortgages into complex financial products that they knew were fundamentally unstable. When the whole house of cards inevitably collapsed, they got bailed out. Within just a few years, they were back to record profitability, handing out huge bonuses, while millions of ordinary people lost their homes, their jobs, and their life savings. The system actively rewards the banks for behavior that harms everyone else. And until this fundamental structure is changed, crises will continue to enrich the few at the expense of the many. So, why do banks get richer during financial crises? It's a perfect storm. They buy up distressed assets for cheap. They receive massive government bailouts and enjoy hidden subsidies that give them an unfair advantage. They profit from wide interest rate spreads by borrowing low and lending high. They consolidate their power by swallowing up smaller competitors. And most importantly, they face almost no real consequences for their risky behavior. The game is rigged, and until we, the public, demand real, structural reform, this cycle is doomed to repeat itself. If this video opened your eyes, please share it with someone you know, and let's keep this important conversation going at Stoicaine Official Channel. Thanks for watching.